Welcome, curious minds, to another deep dive. You often see these big economic headlines flashing, like the U.S. GDP rebounding sharply. Sounds pretty impressive, right?
It does on the surface.
But here on the deep dive, we know the real story usually hides, well, beneath the surface. So today, we're aiming to cut through that noise. We're digging into the comprehensive weekly market brief from first week of August 2025 to uncover what's really showing those numbers.
Exactly. Our mission is finding those surprising facts, those nuggets of truth, and helping you understand what they truly mean for the bigger economic picture and, maybe more importantly, for you personally.
Absolutely. It's vital we look past those initial figures because, well, as we're about to see, the headline often tells only a tiny fraction of the story.
And sometimes, it can even be quite misleading if you don't have that crucial context.
Okay, so let's dive right into that headline figure then. U.S. real GDP grew at a 3.0% annualized pace in the second quarter.
Yep, 3.0%.
That's a pretty sharp rebound from the, 0.5% contraction in the prior quarter?
It's a big swing, yeah.
So a 3% bounce back sounds like the U.S. economy is just roaring back to life, doesn't it? But if we're looking for the real story, is it really that simple?
It's far from simple. And this is really where the deeper insight lies. While 3.0% looks fantastic on paper, a massive chunk of that growth, it wasn't really new domestic activity at all. It was actually driven by a sharp drop in imports.
A drop in imports boosting GDP. That feels kind of counterintuitive. How does less stuff coming into the country translate into an economic rebound?
That's a great question. And you're right. It wasn't a sign of, say, surging domestic demand. Instead, it was largely an unwinding, sort of a correction from a surge we saw back in the first quarter. See, back then, many firms bought a load of foreign goods and built up their inventories. They were essentially front-loading purchases, probably anticipating those impending tariffs everyone was talking about.
Oh, okay. So they bought ahead of time.
Exactly. So this quarter's drop in imports just made the GDP calculation look stronger on paper because imports are subtracted in the formula. Fewer imports meant a smaller negative number, hence a bigger positive GDP figure.
So it's less about a sudden burst of new economic activity, people buying more things or businesses investing heavily.
Right.
And more about businesses just reacting strategically to trade policy, to those upcoming tariffs.
Precisely.
So what does that tell us about the underlying trend then? If we strip out those volatile bits, the trade swings, the inventory changes, what's actually happening with private domestic demand, consumer spending, business investment.
Yeah, that's the crucial question. And when you strip out those volatile components, what you see is that private domestic demand is actually still cooling. Gradually, yes, but definitely cooling. And that underlying trend, that cooling, is much more consistent with slower, more restrained growth rather than the robust recovery the 3% headline might make you think.
Okay, so we've spotted this underlying cooling trend. But what does this imply for the road ahead, especially with those tariffs you mentioned still looming? How's that likely to play out in the second half of the year?
Well, the general expectation is that the economic drag from those tariffs will start to materialize more fully in the second half.
So the impact is still coming?
We think so, yes.
Yeah.
This will likely weigh on overall economic activity, and importantly, it could put further upward pressure on inflation, which nobody really wants right now.
Right. So the key takeaway for you, for anyone listening and trying to get a handle on these economic waters, is that we're looking at an economy that isn't, collapsing or falling off a cliff.
No, not capitulating.
But it's certainly cooling beneath that maybe overly impressive headline number. And understanding this nuance, this difference between the headline and the underlying trend is just crucial for interpreting economic reports and seeing how they truly impact everything from job prospects to the prices you pay every day.
Couldn't agree more. Context is everything with these numbers.
So we've dug deep into last week's kind of hidden GDP story. But what about the next week? What are the key global economic signals we should be watching for? Things that might either confirm or maybe challenge this picture we're building of global economic health.
Yeah, there are definitely several important data points coming up that we should keep an eye on. On Tuesday, for instance, we'll get China's Cakes and Composite PMI for July. The prior reading was 51.3.
And that gives us the sense of?
It gives us a real-time pulse check on the health of their manufacturing and service sectors. Kind of an overall business activity indicator for China.
Okay. What else on Tuesday?
Also on Tuesday, we get the Eurozone Producer Price Index, the PPI, for June. Think of this as inflation that businesses are facing before it potentially gets passed on to consumers. So it can be an early warning sign for your wallet.
Right, factory gate prices.
Exactly. And then from the U.S., the ISM non-manufacturing PMI for July, the prior was 50.8. This is our key indicator for the strength of the really vital services sector in the U.S. economy.
Okay, so Tuesday looks packed. A good global snapshot. What's coming up on Wednesday that's equally critical?
Wednesday brings us more consumer insights, this time from the Eurozone with their retail sales figures for June. They were down 0.7% month over month previously, so we'll see if that trend continued.
Which tells us about consumer confidence.
Exactly. Consumer confidence, spending power, that sort of thing. Also on Wednesday, we get Japan's average cash earnings for June. They were up 1.0% year over year previously. That gives us insight into their wage growth and, the potential for consumer spending there.
Got it. Sounds like a lot tied directly to what people are actually spending and earning across different regions. What about Thursday? Anything major?
Thursday is quite significant, especially for the UK. We have the Bank of England's interest rate decision for August. Their prior rate was 4.25%.
Always a big one. Central bank decisions.
Absolutely. They have massive ripple effects on borrowing costs for pretty much everything. Mortgages, business loans, you name it. Also from the UK, on Thursday, we get the Halifax House Price Index for July. It was up 2.5% year over year, so we'll see if their housing market is staying warm.
Okay, go in housing for the UK.
Okay.
And to round out the week's critical data.
Finally, on Saturday, we look back to China for their headline CPI consumer price inflation for July. It was notably very low previously, just 0.1% year over year.
Yeah, 0.1% inflation.
Yeah, it really stands out globally. So watching that figure is crucial for understanding inflation trends, or maybe the lack thereof, in one of the world's largest economies. All these announcements, they can certainly create ripples across the markets and should give us a much clearer picture of where global economic health stands.
Definitely things to watch. Okay, let's pivot now and look at how the markets actually reacted last week. Yeah. Starting with equities, stocks. Well, wasn't a great week, was it?
No, generally down.
We saw overall downward movement in the major indices. MSCI Europe down 2.7%. The German DAX down 3.3%. France's CAC 40 fell 3.7%.
Yeah.
Over in the U.S., the S&P 500 slipped 2.3%, and MSCI China was down 3.4%.
Yeah, broad declines.
So, given our earlier discussion about the economy maybe cooling beneath the surface, what does that tell us when we look at the specific sector performance within those markets? Does it sort of confirm our suspicions?
I think it absolutely does. What really jumps out when you look at the sectors is how they performed relative to each other. Consumer discretionary, think non-essential goods and services, saw a really significant drop of 4.1%.
Ouch.
And healthcare was also down quite a bit, 3.5%. These are sectors that typically do well when the economy is strong, when people feel confident about spending on extras or, elective procedures.
Right, the cyclicals.
Exactly. But in contrast, the utility sector was actually the only one with a positive change. It was up 0.7%.
Utilities up while discretionary is down.
Yeah. Huh.
For someone trying to, read the tea leaves here, what does that pattern often signal about investor sentiment?
It's a pretty classic signal of economic caution, really. Defensive sectors like utilities companies providing essential services like electricity, water, things people need regardless of the economic climate, they tend to hold up much better when investors get worried about slower growth or even a potential downturn.
Because people still need to keep the lights on.
Precisely. So this shift away from those cyclical sectors like consumer discretionary and into defensive ones like utilities is a textbook sign of investors maybe tightening their belts, adopting a more cautious outlook, and that aligns perfectly with that narrative we discussed about cooling private domestic demand.
Interesting how the market seems to be reflecting that underlying story. Okay, shifting gears to bonds. The U.S. 10-year Treasury yield dropped quite notably, 17 basis points. That's 0.17%. It ended the week at 4.21%. That's a decent dip for such a key indicator.
It is a significant move. And what's fascinating here is what falling bond yields can signify. Often it means investors are seeking safety. They're moving money into government bonds, which are seen as less risky, perhaps because they expect slower economic growth ahead, or maybe even future interest rate cuts from the central bank.
So a flight to safety. But is it consistent across the board?
Well, that's where it gets interesting. It's worth contrasting that move in safe government bonds with what happened in the global high-yield bond market, sometimes called junk bonds.
Okay.
The spreads there, that's the extra yield investors demand for holding riskier corporate debt, actually increased by 21 basis points to 330 basis points over government bonds.
So yields down on safe stuff, but the risk premium up on riskier stuff.
Exactly. It suggests that while there's a general flight to safety in government bonds, there are also some underlying concerns bubbling up about credit quality for less creditworthy borrowers. So a bit of a mixed signal there, indicating higher perceived risk in some corners of the market.
Okay, that adds another layer. And how about commodities? We saw Brent crude oil up significantly, 6.0% to $73 a barrel. And gold also saw an increase, up 0.5% to $303.49 an ounce last week.
Right. Gold often acts as that classic safe haven asset during times of uncertainty or market jitters, which, aligns with some of the cautious sentiment we're seeing elsewhere. It's where investors tend to flock when they're unsure about stocks or other assets.
Makes sense. And oil, almost $75 a barrel again.
Yeah, oil prices can be a bit more complex. They reflect a mix of supply and demand dynamics, of course, but geopolitical factors can also play a big role, making it quite a volatile barometer sometimes. That 6% jump could be due to supply concerns, demand expectations, or other factors entirely.
Gotcha. We also saw some currency movements, the dollar holding relatively steady against the euro at around 1.16 and strengthening a bit against the yen to 148 yen per dollar. And finally, let's talk about volatility. The VIX index, often called the market's fear gauge. It jumped from 15 to 20 over the week.
Yeah, that's quite a significant jump from 15 to 20.
What does that tell us? If the VIX is the fear gauge, sounds like the market just got maybe a serious case of the jitters. Is that just a minor tremble or something more?
An increase like that from 15 up to 20 signals a really notable uptick in market anxiety and uncertainty among investors. When the VIX rises this much, it essentially means options traders are pricing in, or expecting, larger price swings in the stock market in the near future. It indicates heightened fear and potentially more turbulent times ahead. Not panic necessarily, but definitely increased nervousness.
It really is compelling how all these diverse numbers, stock sectors, bond yields, moving in different directions, commodities like gold and oil, currencies, and then this jump in the fear gauge, they might seem scattered, but they actually contribute to a pretty coherent narrative, don't they?
They really do. They're all pieces of the same puzzle, painting a picture about investor sentiment and the economy's current state. When you put them together, you start to get a much clearer view than any single number could give you.
Okay, let's try and bring it all together now with a quick global economic health check, looking at the latest big picture numbers, the macro GDP and CPI figures for key regions. What are they telling us?
Well, the variations are quite stark right now.
Yeah, we see Japan reporting negative GDP growth, minus 0.2%. That contrasts pretty sharply with the U.S. headline number we discussed, 3.0%, and the U.K. also reporting 3.0%. The Eurozone was more subdued at 0.4%, and China came in at 4.5%.
Right, and then you add in the inflation picture.
Especially China's CPI, which you mentioned is incredibly low at just 0.1%.
Exactly. So if we connect this to the bigger picture, these regional variations really highlight very different economic challenges and strengths across the globe. Japan's negative growth underscores its ongoing struggle with, weak demand and those persistent deflationary pressures.
Still fighting deflation after all these years.
Pretty much. Meanwhile, China's super low CPI suggests very limited inflationary pressure there, maybe even some deflationary concerns too, which contrast sharply with the higher inflation that most other major economies have been grappling with.
And the U.S. and U.K., those strong GDP numbers.
Well, as we discussed with the U.S., while they look positive on the surface, they still need to be viewed with those nuances in mind, the import effects, the underlying cooling trends. It's not quite as simple as the headline suggests.
Okay. And let's wrap up this section with equity valuations, specifically looking at forward price to earnings, or PE ratios. The S&P 500 really stands out here with the highest valuation, doesn't it? It's at 22.3.
It does, yeah.
That compares to MSCI Europe at 14.1, the UK's FTSE 100 at 12.8, and MSCI Emerging Markets also at 12.8. So the U.S. market looks quite a bit pricier relative to expected earnings.
That's right. The PE ratio basically tells you how much investors are willing to pay today for each dollar of a company's projected future earnings. So a higher PE, like the S&P 500's 22.3, suggests investors have pretty high expectations for future earnings growth in the U.S., or perhaps that U.S. assets are just generally more expensive compared to their earnings potential right now.
And why is that particularly noteworthy, especially in this environment we've identified as, potentially cooling economically?
It's noteworthy because Given that we've identified the underlying economic trend, particularly in the U.S., as cooling, this high valuation implies a very optimistic outlook for U.S. corporate earnings, even as the broader economy seems to be facing some headwinds. It definitely raises a question about whether that level of optimism is fully justified by the underlying data, or if the market might be a bit ahead of itself.
Interesting point. It feels like these final macro numbers, the GDP comparisons, the inflation variations, the valuations they really provide that crucial backdrop for understanding investment decisions and the overall global economic health, giving us some perspective on where value, or maybe risk, might truly lie.
Absolutely. It sets the stage.
So we've taken quite a deep dive today. We uncovered that nuanced story behind the U.S. GDP number, looking beyond the headline to understand the underlying cooling trend driven by those import swings.
Peeling back the layers.
We've surveyed the mixed signals coming from global markets, falling equity indices overall, but defensive sectors holding up, that split in the bond market, rising volatility.
Lots of cross currents.
And we've mapped out the key economic events coming up next week that you should keep an eye on.
Yeah.
It really is a testament, I think, to the value of truly getting into the data, not just skimming the surface.
Absolutely. Those real aha moments, they happen when you connect the dots between these seemingly disparate data points. You move from just looking at numbers to actually understanding the coherent narrative they're telling.
It definitely raises an important question, maybe a provocative thought for you, the listener, to consider. Given that underlying private domestic demand is cooling, and we expect those tariffs to create further economic drag in the second half of the year, how might this really shape the investment landscape? And how might it affect consumer behavior in the coming months, even if some headline numbers occasionally bounce back and look strong?
It's a complex picture, for sure, and it really underlines why continuing to think critically about the economic news, digging into the details, and understanding how seemingly small points can reveal big truths, why that's all so essential for anyone trying to navigate these shifting economic tides.
Couldn't agree more. Thank you so much for joining us on this deep dive into the numbers. We really hope it's given you a clearer, more nuanced picture of what's truly happening in the global economy right now.